Hey, good morning, everyone. Welcome to this Thursday, December 21st, 2023 edition, Trading Places Live at EarningsBeats.com. I'm Tom Boley, Chief Market Strategist here at EarningsBeats, and I'll be with you for the next, 30 minutes or so as we prepare for yet another trading day as 2023 continues to wind down. I do want to make a couple of announcements quick before we get going. Next week is going to be an off week for EarningsBeats, so the Christmas to New Year's holiday, we're down to really a skeletal staff, not going to really do a lot of the things we typically do, just because a lot of you all, I'm sure, will be traveling with families kind of like we are. So no shows next week, no live trading room. The daily market reports that normally come out probably will be out maybe once or twice next week. We'll kind of keep an eye on the action and kind of keep you posted as far as what's going on in the market. But it's definitely going to be, it'll probably be shorter reports. It'll probably just be real quick updates throughout the holidays to keep you posted. But again, no shows, no trading room on Wednesday. So I want to make sure that everyone is aware. I haven't decided on the weekly market report. Chances are I'm not going to do one next week, and I don't know about the week after, simply because Christmas and New Year both fall on Monday, which is, normally either Sunday or Monday. I try to get that weekly report out. I just don't think the calendar is going to line up for us for that. So I would not be expecting the weekly report unless I move it to Tuesday and then go to a daily report or something, the rest of that week. All right, let's go ahead and move over to the action from yesterday, Wednesday, December 20th. The Dow Jones Industrial Average down 1.27%. S&P 500 down almost 1.5%. NASDAQ 100 down 1.5%. The mid caps down a little more than 1.5%. And the small caps down almost 2%. So it was an across the board sell-off, really unlike anything we've seen in the last few weeks at least. Lots of things just kind of turned south about 1 or 2 o'clock yesterday, and we saw a pretty hard sell-off into the close. I can tell you futures are up pretty nicely though this morning, as if nothing really happened. In a bear market, after finishing like we did yesterday, I would have probably expected that we would have seen continuation of that selling at the opening today, but we're not seeing that. I'll give you some numbers in just a second. Right now, well, as of 10 minutes ago, this is what I'm looking at. Actually, I'll give you the real time. Hold on one sec. So I'll go through and give you the ETFs that track the major indices. So the diamonds, which track the Dow Jones, currently up almost 0.6%. So about half of what they lost yesterday. They look poised to gain at the opening bell today. The Spider, which was down 1.4% yesterday, up 0.7% pre-market today. So again, looks like it's going to pick up about half of yesterday's loss. The QQQ, which also dropped 1.5% yesterday, up more than 1% this morning. So most of those losses being picked right back up on the QQQ. And then the IWM, which tracks the small cap Russell 2000, yesterday down almost 2%. Today up about 1.2% pre-market. So getting a lot of that back as well. I think personally, as long as we're above rising 20-day moving averages, I'm fine. As I said before, it's really hard to determine where a short-term pullback is going to occur. Sometimes we'll get some signals like negative divergences on like a 60-minute chart, something like that, or maybe some really strong bullishness in the options world where, that can be a contrarian indicator. A lot of times that's what I use it for, as a contrarian indicator. So when things get overly bullish, you can sometimes look for a short-term pullback or correction. Of course, when they're overly bearish, you can expect the opposite, a big rally off of that. But overall, I mean, I think, the market continues to be in an uptrend. I mean, like I said, you're going to have these pullbacks from time to time, like we had yesterday. The question is, does it morph into something more? Do we get down to the 20-day moving average? For me, I kind of look at the market now as though it's in a range. And I feel like our range has now been set at the top, at least in the near term. Because anytime you get a big sell-off like that, finish on your lows after setting a new high intraday, excuse me, I usually look at that high from yesterday as kind of a key resistance level because that's where all the selling began. So when we get back up there, I would expect maybe you would see some more sellers. If we don't, and we go right back through, then we're continuing just to trend higher in this current secular bull market uptrend. But if we can't get through there, if we go back up, can't get through, turn back around and go back down below today's or yesterday's low, then I think we're setting up more like maybe this is going to be the 20-day test. So how you treat that and how you trade that really comes down to each individual. What risk you're willing to take. There were a lot of false breakouts yesterday. That always gets my attention when it looks like we're going to get a nice breakout. I'll go over one particular stock that I talked about in our trading room yesterday that was up. It was right at resistance when we were talking about it in the trading room. And then we fell probably a couple percent from there, leaving a tail, which was high enough to take out the previous highs on the chart, but we didn't get that confirmed close. And so short term, that tends to bother me a little bit. All right, let's keep moving down here to the sectors. Communication services. On that kind of a day yesterday, I would not have been expecting communication services to lead the market. And it led by a wide margin or fairly wide margin. You had communication services dropping about 0.75%, and that was the best performing sector. So all 11 sectors were down yesterday. It was definitely a broad-based decline, and again, led by communication services. Another thing I thought was very interesting was the two worst groups. I mean, again, if you think back to this rally, the rally's been all about the aggressive groups. Everything's kind of going along for the ride. We're getting some industrials setting an all-time high, the XLI, along with the XLK. But it's been mostly those aggressive groups that have been taking us higher. So when you get your first big sell-off, I would have thought it would have been normal if we had just seen selling perhaps a little stronger in technology, discretionary communication services. And that's really not what we saw. Here are the two that led to the downside. Utilities dropping a little more than 2%, and staples dropping almost 2%. Those are clearly defensive areas of the market, and they underperformed. A little strange on a big pullback like that. Normally, again, we see those aggressive stocks with some profit taking down in that leading laggard role, if you will. Aluminum. I think yesterday I had them up here as one of the top performing groups, or maybe it was the top performing group. Well, yesterday it was the worst performing group. So it went from number 1 out of 104 groups to number 104 out of 104 groups. That was quite the reversal on aluminum. Internet stocks actually did fairly well, gaining 0.44%. It was one of only 3 groups that were higher yesterday. So again, yesterday I was talking about the breadth being so strong. 95 industry groups out of 104 moving higher. Well, yesterday 101 out of 104 were down. The other 2 that were up was marine transportation and trucking. Those were the only 3, along with the internet stocks. Those were the only 3 industry groups that were up. All 11 sectors down, all the major indices down. Clearly, it was a broad-based decline on Wednesday. Delivery services also very weak, down over 5%. So moving back down below 20-day moving average. That's never a good thing in the near term. So that related to FedEx. If you didn't catch the FedEx earnings news, definitely worse than expected. Wall Street was not happy with FedEx. FedEx took a pretty big drop. And as a result, delivery services went right down with it in sympathy. All right, 10-year Treasury yield. You know what? I did not look to see economic reports, but I know we got initial jobless claims because we always get that on Thursday. Let's take first a look at initial jobless claims. 205,000 versus 210,000 expected. So that was below expectation. GDP. So this is going to be the final of the third quarter. And it was back down to 4.9%. So remember the initial estimate 2 months ago came out 4.9. Last month, we had the second estimate come in at 5.2. This is the final, and it's dropped back down to that 4.9. The thing, though, that maybe is maybe giving the market a little bit of a lift this morning is that the personal consumption expenditures, the PCE, the annual rate, this is a number that the Fed looks at. The annual rate in the second estimate, it was 3.6. The consensus for this final estimate was 3.6, and the annual rate came in at 3.1. So quite a bit lower and getting close to those twos. So I think that probably certainly has helped the market move back to the upside and maybe, I don't know, maybe reverse some of that selling. But again, I think technically we need to get up and take out that prior high. Let's see if there were any other. Oh, yeah, Philadelphia Fed Manufacturing Index. The consensus was -3. It came in -10.5. So little disappointment there. And leading indicators will be out at 10 a.m. So they haven't been out yet, but the consensus is for a drop of 0.5% last month. And that's for November, by the way. This is a little bit of a dated report. But the prior month, so October, was -0.8%. And now the consensus for this month or for November is -0.5. So we'll see how that comes out. That will be coming out, like I said, at 10 a.m. this morning. So if you see any kind of a big change in the market, could be as a result of that, although I don't think it'll be a huge mover unless it's way off consensus. Let's move over to the S&P 500. So if you look back, I mean, I would say that since the October 27th low, I think yesterday qualifies maybe as the worst day we've seen. The volume was just kind of so-so, so it wasn't massive volume in total, but it was very light volume until probably early to mid-afternoon, and then the volume accelerated. I can show you on a 5-day chart what I'm talking about. So here you can see, you know, we were just kind of drifting up on relatively light volume, and then after 2 o'clock, well, maybe even a little bit before 2, we started to see the selling, and it started to accelerate around 2:30, and then the volume finally started to pick up at just before 3 o'clock Eastern. And with that, you can see we closed on the low. That was a pretty big drop, not only taking out Tuesday's low, but also took out Monday's low and last week's low. I mean, we went all the way down. Sorry about that. We go all the way down, went all the way down past all the closes from the last week, only staying just slightly above the intraday low back on Thursday of last week. So there was a lot of selling. We wiped out the gains from 5 days in about 2 hours, maybe 2.5 hours. So definitely a lot of selling that took place. And now what I'm talking about we need to watch is an intraday high, which was over 47.75, 47.78, getting really close. I think the high candle body all time, meaning open or close, I think the open might have been 48.04, and I think the high close might have been like 47.93. I'd have to go back and double check that, but I believe those numbers are right or pretty close. And we were right up there on the S&P. Of course, we already cleared overhead all-time highs on the Dow, on the NASDAQ, on the XLK, on the XLI, some key areas. But we hadn't yet done it on the S&P 500, which includes more of those value-oriented and defensive-oriented stocks that haven't kept pace. And so it's a little bit of a laggard, but we got close yesterday and then reversed. So we'll see where we are right now. It would be pretty interesting if we closed right about here at the end of the year, because that was my prediction at the beginning of this year in the 2023 Market Vision event. I had 4,700 as the close for 2023. 46.98 on December 20th isn't bad. I mean, that's pretty darn close. We'll see what happens over the next 10 days, though, which is a very bullish period, by the way. The NASDAQ, you can see again reversing. See how the intraday high we had topped the previous day. So we had gapped down early, but then we got enough strength to go up and push to new highs and then couldn't hold. and went all the way back down and finished at the low. You know, if I didn't know what kind of market we were in, and I just had maybe the last 10 days of this chart here, and I was just simply looking right here in December, and I saw this candle, if I didn't know anything else, I would say, I think we're going to go down further. It just doesn't, it's not a good candle. And on the NASDAQ, I mean, do we have a negative divergence? It's kind of questionable at this point. I think if we look at the S&P 500, you can see that already was cleared to the upside. But still, a move back down to the 20-day moving average certainly can't be ruled out. And even with the strong futures today, I don't rule out the sell-off from yesterday continuing. If you think about the S&P, let's see, where are we? I mean, if you about 0.75%, which would be what, about 35 points on the S&P. So if we go up 35 points, I mean, we're talking about, you know, getting back up to about 47, 35, somewhere in that range. We may go up a little bit today, but I still, until I see the breakout, I would assume in the short term, I'm just talking short term. I'm not bearish. Don't, you know, short term cautious is always a better way to describe me during a secular bull market advance. I don't get bearish during what I think is a secular bull market run to the upside. But you can get cautious. You can say, okay, we've had a big run. It wouldn't be horrible if the market were to pull back here, maybe even another 50, 75 points. Get back down close to that 20-day moving average. All right, move on. Excuse me. Moving on, IWM, the iShares Russell 2000. We were up to 202.50, coming back down. Now, I will say on this one, I would throw in some support. I mean, we had big gap ups here and on heavy volume. So the IWM, I think, has pretty good support where we closed yesterday. But down below around 192.50, we had a very heavy volume gap up from there. I would certainly expect that there would be buyers if we were to get down to 192.50. And again, I'm not saying we're going there. I think it's possible. I'm personally just sticking with the IWM at this point. If we get down to that gap support, and especially if we get down to the 20-day, I'll be thinking about leverage, a little bit more into leverage. Also, if you know, historically, the week between Christmas and New Year, that is a very strong week, not just for the overall market, but for small caps in particular. So I'm kind of watching. I might swap out some IWM for TNA, something along those lines. Just understand anytime you use leverage, it's a lot riskier. I mean, it sounds great if the market goes up, but if the market goes down, those triples are not fun. So I would just throw out there, make sure you understand the risks. There's a lot of risk anytime you use leverage, whether it's margin, whether it's options, whether it's these 2 times or 3 times leveraged ETFs. All of these carry a lot more risk. So make sure you understand the risk you are taking. Really important. But anyway, for me, the closer I get down to some key levels, that's when I want to consider leverage, because I can get out quickly if I'm wrong. And either get out of the market or I go right back to the IWM, whatever I want to do, but I can take that additional risk out quickly if I'm wrong. And that's what I generally talk about with using risk, is you want to be either at a major breakout level where you're getting a breakout, or you can get it on a pullback. Use leverage on a pullback to an area where you believe the stock market is going to hold support. And so for me, again, I think it's that gap support plus that rising 20-day moving average. Anything in that 188 to 192.5 range, that would be an area that I might begin accumulating some TNA. But if you close below the 20, different story. Transports. Transports didn't put in an intraday high, but you can see big gap down, and then we had a big rally, and then we finished all the way back down low. So we moved lower. We started to rally. Here we go back to the upside again, and then it completely fizzled, and we went all the way back down to the low at the close. So not a good looking candle on the transports. Volume did tick up a little bit, but again, mostly because of the last hour and a half. All right, moving on. Let's talk about the upcoming event. So if you go over to EarningsBeats.com, here is the link that you can click on to register for Market Vision 2024. I'll give you a couple of hints. The best way to come to Market Vision 2024 is to be an annual member of EarningsBeats. If you are a full service annual member at EarningsBeats, you will get in free. For the general public, we're charging $697. Our annual membership, full service annual membership, is $997. If you pay that, you get in for the $697 is free. You're getting an immediate $697 return. So it's pretty much a no-brainer. If you are a trial member at EarningsBeats, I would suggest you become an annual member if you like our service, because again, it will cost you nothing. If you're a trial member or a monthly member, it's going to cost $347. So it's half price. But again, we commit. I mean, if you commit to us, we commit to you. Zero cost for this event. And again, if you've been at the last four, you know. Anyway, let's keep moving. So chart of the day, I do want to just go back here and show everyone, if you're new to EarningsBeats, first of all, welcome. We certainly appreciate you. If you go over to EarningsBeats.com, we do have a free newsletter. No credit card required. You can unsubscribe at any time. We do this simply try and build our community, try to educate some of the principles that we stand on at EarningsBeats. Name and email address, all it takes. Comes out 3 times a week. We talk about things that are important to us at EarningsBeats. So you're going to see a lot of relative strength. You're going to see a lot of earnings-related news gaps as a result of that. You're going to see price volume. That's my number one indicator technically. But you'll see other things that we talk about like RSI, AD line, accumulation distribution. You'll see sentiment. I'll talk sometimes about the overall market sentiment. Again, a lot of the things I generally talk about, I'll talk about in the newsletter. So it's a great way 3 times a week to get an update from us. And if you're worried about, oh my gosh, I have so many newsletters and I don't have time, this is a 2-paragraph, 1 chart newsletter. It's really pretty quick to read through the 2 paragraphs and look at the chart. I think it'll help you from an educational standpoint, but I think it also could help you from a trading perspective. Although if you do decide to trade any of them, obviously that's on you. We just lay out information. I give you my opinion. If you want to take the risk, obviously that is all on you. So chart of the day, what I wanted to show you, and this is the chart that we talked about yesterday in the trading room. We were literally this high. I remember the numbers, 141.05. That's where we opened. So if you're looking, for the breakout, we need to get a move through 141.05. Yesterday, we got to 141.70. Look at the volume, very heavy volume. We had the breakout. We had the highest level on Google at any point during the year. So it was blue skies ahead yesterday. When we were doing the event or doing the live trading room, it had come back down. It was sitting at 141.04. It was literally 1 penny below that level. And what I said at the time and what I told members was, I'm pretty bullish. I think Google's going to break out. So I could make an argument for staying in the stock, even if it does fail. But in a bearish environment, or maybe even just a sideways market environment, anytime you get up to price resistance, and you have a profit, sometimes it's a good idea just to take it. Because you can get back in. If it does confirm the close and you do go up and close at 142, you're giving up $1 on the stock. Make sure that it makes the breakout. So it's always a good idea. One of my favorite sayings on Wall Street is you never lose money taking a profit. And that is a true statement. If you have a profit and you take it, you can't lose money on that trade. So there's, something to be said. Clearly always something to be said for price resistance. It depends how long you're intending to hold the trade. And so when you're in a sideways market, or if you're in a bearish market, I don't think it's a good idea to hold, because the overall market is trending down. So if you do get a pop on one of your stocks and you're long and you get up near a resistance level, to me, I would be thinking, thank you. I want to get out and take my money because I'm likely to go lower. And honestly, if we're in a bear market and we get that kind of a move to the upside near a major resistance, that's when I'd actually be thinking about shorting. Forget about just taking a profit. I mean, I would be thinking about shorting in a bear market. In a bull market, I've moved on I've moved on somewhat from really quick trading, and I'm now more into the mindset of swing trading over a longer period of time. So with something like Google, I could take my money and run. I mean, it's one stock we had in a trading room last week. I'm trying to think which one it was. We got in at, I think, 1705, and the resistance was 19. Hoping it comes back to me. Maybe some of you who were in the trading room can type it into the comments. But it was 1705, and the stock, I was looking at resistance at 19, and the next day, it was either that day or the next day, it was at 1860. I'm just looking at this. I'm like, I'm up almost 10% on the stock in a day. It's even in a bull market. If you make 10% in a day, I mean, there's going to be a lot of other stocks you can trade. That's one that's hard to pass up. So I ended up selling it right near that 1860 level. I think taking profits, especially quick profits like that, makes a lot of sense. All right. I know yesterday there were a number of questions in here, and I didn't really get to them. So I think maybe we got a couple minutes here. I'm going to just go through some of the questions. And again, I want to thank all of you that watch the show every day religiously. Be sure to hit the like button and make sure you subscribe to the channel. Those things really help us, and pass it along. I mean, if you're going out with some friends or something, you see people over the holidays and you're talking about, wow, the stock market's up, at or near all-time highs. Hey, let them know. You got to check this guy out. Tom Bowley over at EarningsBeats. Been following him for a while. Give us a shout out. We appreciate that. Question: why does it take the Fed, you read my mind, at least 6 months to figure out what participants in the economy already knew? I think the Fed's mandate, number one, I mean, they have two mandates. They want to maximize employment, but they also want to stabilize prices. And I think if you ask them their priority, they would say stabilize prices. Forget about the economy. They don't forget about the current economy. If they have to choose, they're going to try to extinguish inflation. And I don't disagree with that. Part I disagree with is that inflation has been showing signs of moving lower for quite some time. And if you know the history of the Fed, they started off, Powell was just like, we just need to see that there's a turn. We need to see that the CPI, core CPI, no longer is going up. We need to see it start to move in the other direction. And so we saw that. And then he came out the next Fed meeting and said, yeah, we're definitely seeing, at least a short-term turn, but we need more. We need to see it be more consistent. We need at least a couple of these readings. Okay, so then we had another reading, a couple of these readings. And by the way, while this was all happening, they continued to raise at crazy rates, 50 basis points, then 75 basis points, 4 times after the market had already started to show what they said they wanted to see. So, yeah, you could really get me going on this one. I'm not a big fan of Powell. And then, the next meeting they came out, they said, well, we need to see a more of a move back down toward our range, which was 2%. It's like his wording kept changing. I mean, what do you really want to see with inflation? Fed tries to be transparent, but it's not transparency when you keep changing what you're looking for. How is that transparent? So I had a lot of issues with Powell throughout this. And when inflation was coming down and the market hit that bottom in June of 2022 and started to go back up, we had a 700-point rally on the S&P 500. And then we started to roll over a little bit. And then we had that Jackson Hole speech, remember? More pain ahead. So then Powell became a stock market prognosticator. He started deciding that, hey, I can tell you better than you what the stock market's going to do. Sorry, I don't need that, Chief Powell. I don't need your stock market indicators or whatever you're using to try and determine whether or not we're going to see more pain ahead. So that absolutely drove me crazy. Steve mentioned LMND. That was the stock. Thank you for that, Steve. That was at 1705. I mean, during the trading room, it was at that price confirmed when I bought. And I think it was one day. We'll pull that up right now. I believe it was this day. And yeah, it was the same day, right? I think it was that Wednesday, Thursday, Wednesday, Tuesday, Monday, Friday, Thursday. Yeah, it was Wednesday. Same day. So you get it at 1705 and the same day it's 1860. That to me, I don't care about my long-term swing trade. I mean, I don't know what I'm holding it for, but 9% in a day, the reward to risk kind of shifts because at this move, here was that 19 resistance I was talking about. And look what happened here over the next day we gap up. Yeah, if I held maybe one more morning or something, I could have done better. But look at this reversal and look at where we are again. Right back down at 17. So if I just held it, I would have no profit right now. I took 9% in a day. Market makers can't get that back from me. You know, if they reverse it like they did here on everybody else that was in the stock and trading it, they didn't get my money. Anyway, one way to look at it. Let's take a quick look at the market, see where we are. So we got the Dow up 264, S&P up 38, NASDAQ up 161, 1.1%. Still not wiping out all the losses from yesterday, but certainly making a little headway there. Small caps up 1.23%. And I'm going to pull up the IWM on a short-term 5-day chart. I like to follow this sometimes. So here you go. So we're making a move. I don't know if this is going back up here to take out this double top over 202 or if it's just a knee-jerk reaction back to the upside in the short term from all the selling we saw. I mean, you could probably slip maybe a Fibonacci on here. I don't know that I use it too much for intraday. But if you just wanted to see maybe where a level might be, if I go up to that 61.8% level, you might see if, you know, maybe we get to there and start to reverse back down. It's hard for me to say what everyone should do because it just depends on what kind of trader you are and, you know, how much risk you're willing to take and the types of trades you make, you know, your overall risk tolerance. And so it would be different depending on where you're at. For me, I'm aggressive. I'm sticking with the IWM. And if I break back out again, great. And if I go lower, that's going to be an opportunity for me to get out of the IWM and move into some more leverage or get out of some of the IWM. So it just depends where you stand and what you're willing to risk. You know, I sent out the daily market report a little late yesterday. It was late in the day because I was trying to figure out what was going on in the afternoon. But what I mentioned there was, or I think I mentioned it in there, if you're really conservative, or maybe I mentioned it during the live trading room yesterday. I can't even keep track where I say things because I say so many things so many different times. But you know, if you're really conservative and you've been riding some of this up with a small portion of your portfolio and you really are not risky, I mean, we've made a big move. This is a potential short-term topping signal. And so if you just want to capture that as a more risk-averse trader, somebody who really doesn't like risk, this bounce back up today is probably an opportunity to do that, to take your money, sit back on the sidelines and just relax because you don't want your capital at risk for, you know, when you think things might turn a little bit lower here. And if we break back out again, you could get back in if you want, or you can just wait for that. At some point, we're going to get a sideways move. And at some point, we're going to test the 20-day moving average. I don't know when it'll be, but at some point we will. Anyway, that's basically it for me today. Again, no shows next week. So I just want to wish everybody happy holidays. Please be safe if you're traveling. I know a lot of people travel over the holidays. We'll be traveling as well, going down to Florida to see some family. So if you're traveling, just try to make sure you're safe, get home safe, and the market will be waiting for us when we get back to the beginning of the year. So Merry Christmas, Happy Holidays, Happy New Year to those that I only see here. But we will be back that first week of the new year. So take care, everybody, and enjoy the holidays. Happy trading.